webinar. Just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia, PA. And I've been involved in the financial markets for over 20 years. And I began trading the futures and forex markets about 10 years ago. And I have been involved in the optimization of software systems for the last 10 years via mathematical modeling. In fact, that's a lot of the work I did while I was at Penn, and that was the development of software systems or mathematical modeling to optimize things such as underwater decompression schedules, other multivariable equations that needed mathematical modeling via computer. And just, Right Line Trading's at www.rightlinetrading.com. And this is a unique business. Many vendors ask you to buy software or trading techniques that you can't even see until after you buy them. But the most important thing is they come with back-tested strategies and entries that have no mathematically quantifiable predictive value. And many of the systems are just plain broken. I mean, what we've done here at Right Line Trading is we have defined all the variables that we feel are important in determining the sensitivity, specificity, and positive and negative predictive value of taking a trading entry, put them into a multivariable equation, and optimized each of those variables independently to come up with a trading plan in which we know is going to provide you with a trading entry with a very high positive predictive value. I've talked to a lot of people who give webinars, and when I ask them, well, on your buy on the blue dot, sell on the red dot system, what's the sensitivity and specificity of your entry? And what is the positive predictive value of your entry? And nobody knows that. And without understanding those numbers, you can't tell if your software works. You can't tell what the value of a trading entry is, because those are the critical numbers in determining whether or not, if people follow your plan, they're going to wind up being a profitable day trader. Now, the parameters that we've outlined that are really critical in determining the predictive value of an entry are really walk along the following path. Now, there are people who have different strategies in terms of developing software to define market direction. And the first group of people believe that price action alone will provide you with a buy-sell trigger with a sensitivity, specificity, and predictive value high enough to make you a profitable trader. And then there's the indicator analysis crowd. And those people believe that some unique composition of indicator signals, some confluence of indicator signals, will provide you with a buy-sell trigger that's with a predictive value high enough to provide you, again, with a profitable entry. And a further subdivision of all of these people are ones that believe that one time frame is good enough to trade, and those that believe that higher time frames are required to confirm the validity of the entry. At Right Line Trading, we sort of reject and embrace all of these hypotheses at the same time. We don't believe that price action alone provides you with enough information to get you to the sensitivity, specificity, and positive predictive value that you need, but that price action is a really critical piece of information required to be optimized in that multivariable equation. And price action market structure is really probably 75% of that multivariable equation. Neither do we believe that any specific confluence of indicator signals is going to be powerful enough without taking into account price action and market structure are also going to get you to where you want to be. Now, if either of the above were true, it would be very, very easy to robot trade the markets for $1 million in profit. I mean, if an oscillator being in position A, a MACD being in position B, order flow being in position C, some indicator confluence being in a certain position guaranteed that your long entry was going to be a successful one or your short a successful one, then that would have been stumbled upon a long time ago by a computer. The fact is that there is no magic indicator confluence, and there is no magic price action pattern that's going to get you to that's going to give you a trading entry with a high enough predictive value to make you profitable. So what we did was we looked at all of the different variables, and so ultimately became the goal of the software program that we use to combine all of the following elements. Now, extremely importantly is market structure. And you can call market structure price action. And market structure slash price action, I believe, is about 75% of the requirements in terms of the data that goes into a trade that gives that trade significant validity. Or, to put it mildly, to give it in mathematical terms, significant precision. Indicator analysis is extremely important as well. It helps to confirm what you see in terms of your indicator, in terms of market structure. If indicator analysis confirms that market structure is appropriate, the predictive value of your trade is going to go higher. And then if you do fractal analysis, and then as you look at market structure, and this is the type of thing that's not done in any other trading program that I know of. So if you look at market structure on multiple time frames, and you look at indicator analysis on multiple time frames, which is known as fractal analysis, then the predictive value of your trading entries goes up even higher. Now, if you do this manually, you wind up with a lot of charts on each market, and you have to sit there with a crosshair, and it's very, very, very cumbersome. So what we did was we combined all of these parameters into a simple trading platform that's been optimized mathematically to provide you with remarkable, accurate entries. On Rightline, all of our indicators synthesize indicator data from multiple time frames, and you'll see that. And we also have an indicator as well that synthesizes market structure and price action for multiple time frames. So your trading chart really becomes a powerful one because it's really analyzing data from 2 higher time frames for almost all of the indicator signals that you see. And that's really what you want to do. Now, there are all kinds of trading methodologies that we could use with multi-time frame analysis of price action slash market structure and multi-time frame analysis of indicators. And the things that we do not do is we never trade tops. We never try to call or trade tops or bottoms. Now, it's my personal belief that yes, you can look at the Globex high and low of the previous day. You can create upper and lower support and resistance levels to try to call a top or try to call a bottom. You can use stochastic divergence or momentum divergence to try to give you a reversal signal. But those who call tops and call bottoms do not get signals with enough validity. Do not get signals that call the top and the bottom often enough correctly to make those successful trading entries. And from what I've seen in 10 years of market trading, those that try to call tops and bottoms ultimately wind up with no money in their trading account. So we don't try. So 2 just really reiterates number 1. We don't try to trade reversals. Now we also do not counter trend trade. We believe that institutional traders set the trend, and the big money produces the trend. And we don't want to buck the big money. We want to be with the big money. We want to trade with the trend. And you're going to see when I show you the platform and I show you all the trades that what we look to do is exploit those people in the counter trend trades and try to run them over and try to stop them out to give our entries even more validity. And we do not try and predict breakouts. I have never seen a piece of software that can accurately and repeatedly predict a breakout. I call those there's a word I have that I just can't even think of, but they look at some percentage of the average true range, and if the market moves that percentage, they believe that the market is going to break out, and they put you in the trade. If it breaks out, you usually have a very nice winner and a big winner. But if it doesn't break out, if it's a false breakout, then you wind up getting stopped out, and you usually get stopped out repeatedly when the market's choppy. So as I mentioned earlier, we are only one kind of trader. We are trend traders only. We try to define the trend early, get on board early, and we try to ride the trend as far as we can. Now I've just put this up because I just wanted to show this really quickly. This is price action of crude oil. And you can see, at least from what I can see, I mean, there are signals based on price action and market structure that do give you some hints that the market's going to reverse. If you look at this candle, you can see that it's engulfing the previous candle, and it's really at a swing pivot low. The market starts here, goes up, comes all the way down, then it engulfs to the upside, and maybe you got an upside move. Now, if you look here, you have a move to the downside that comes all the way back to the upside. That's a 100% retracement and another engulfing candle, and that predicts a move to the downside. So there are hints in this chart when you see these swing trades to the bottom and a move up with an engulfing candle. Here's a swing trade from top to down all the way back to the top, again at a swing pivot high with an engulfing candle that predicts a move to the downside. So market structure and price action do give you significant data, but predicting these kinds of turns based on swing pivots and based on engulfing candles just doesn't get you the kind of predictive value you need for taking a reversal trade as often as you would like to. And more often than not, you're going to wind up getting run over in these trades. So what we do is we look to add a little bit of structure to the chart. And what we do is we put in a 50-period simple moving average. And when you're above the 50-period moving average, we believe the bulls are in control and we only go long. When you're below the 50-period moving average, we believe the bears are in control and we only go short. Now remember, we don't counter trend trade. So if you try to go short above the 50, in our rule book, you're counter trend trading. If you try to go long below the 50, you also are counter trend trading. So if you remember, we only trend trade. This kind of move to the downside, we just can't get. But what we're looking for is specificity, not sensitivity. If you look to trade a sensitive program, you're looking to get into all the true positive moves. I don't want to confuse it with these numbers, but I want to what I want to give you is a trading methodology, and really almost a trading mantra. Because I think that a lot of day traders want to try to get into every big move, and they get upset if there's a big move that occurs that they can't get into. But I think if you look at the market that way and you day trade that way, you're not going to be successful, because you're not looking for sensitivity. Sensitivity is you get into every true positive move. But if you trade with sensitivity and try to get into every true positive, you're going to get into a lot of false positives. What you want to do if you trade with specificity is you want to stay out of all the false positives and only take the true positives. So you want to eliminate the false, and you want to eliminate the false negatives. And that's what specificity does for you. It gets you into accurate moves. It gets you into moves with precision, and it gets you into moves that are successful. But the price of that is you've got to let some of these moves go by. Just let them go and not worry about them. Now, we also add a modified 15. And this is a proprietary moving average. It's a 15-period moving average. And we only take a short when the 50 and the 15 are red, and a long when the 50 and the 15 are green. Now, furthermore, we've defined certain other variables in the multivariable equation that goes into determining the positive predictive value of our trade, and the other is how many ticks is the trade off support or resistance. On a long trade, after a lot of work and a lot of back testing and forward testing on market replay, we have found that if the candle body open of a trade is more than 4 ticks off support or resistance, it increases the probability that the trade is going to collapse back to support or fall back up to resistance. And we don't want to get run over. We want to be tight to support or resistance. So we created an indicator that tells us how far off, in this case, this is the modified 15. We're trading off the 15. How many ticks is the candle body open from this trend line? So we can see if this is 4 or less. We know that the risk associated with the trade is small. As this number gets higher and higher, the risk associated with the trade gets bigger. Now, which indicators are important in terms of confirming market structure and price action? The 3 that we found to be the most important are 1 is order flow, 2 stochastic, and 3 momentum. So what we did is we created what's called the 3-line indicator. Now, the 3-line indicator does fractal analysis, and it assimilates data from multiple time frames. Now, as I said, line 1 is order flow, line 2 is stochastic, and line 3 is momentum. Now, when the line is red, it means that either one of these parameters is down on all time frames assessed. When the line is orange, it means that it's down on the long-term time frames, up on the short-term. When it's green, it's up on all time frames analyzed, and when it's blue, it's up on the long-term, short on the downturn. Now, but the 3 critical parameters are order flow, stochastic, and momentum. Now, I'm going to go a little more into stochastic later on, but all of this data is projected right onto the price bars, and you're going to see that you don't have to sit there and watch the colors change. That when all the colors are red or all the colors are green, which is critical, that's what we're looking for, it's projected right onto the price bar, so you really don't even have to spend any time looking at the 3-line indicator. And just to go through these quickly, because I really want to spend a lot of time on the trading platform itself. If you see here, remember we only trend trade. We have the 50 up is green, the modified 15 is up, and the candles outlined in blue. That tells you that order flow, stochastic, and momentum are with you on multiple time frames to the upside. A 2/3 candle break of any trend line, or 2/3 candle close above a trend line, means that the trend line is broken. And that is, you're in one tick above the close to the top, and up you go. Now here, just the opposite. This candle closes completely, and the only thing in candlestick dogma you worry about is you worry about the candle body. Do not worry about the candle wick. The entire candle body closes below the 50. The 50's down, the 15's down. The candle's outlined in yellow, which means order flow, stochastic, and momentum are with you. And that's a multi-time frame analysis to the downside. You're in one tick below the close of the candle, and down you go. Now, all of the data is assimilated intra-bar. So you can see this yellow outline forming, flashing on and off, and you already know that when the candle closes to the downside, that yellow outline is going to print. So you're in that trade. You already have your sell stop or your sell stop limit order sitting one tick below the close of the candle, waiting for the candle to close and mature and give you the short trade. Again, we look for the 50 down and the 15 down. Here's a break of the 15. Now the 15 breaks with order flow, stochastic, and momentum to the downside. You wait for the candle to mature, and you're in one tick below the close of the candle with your sell stop or sell stop limit order. And down you go. Same thing to the upside. Candle moves to the upside. 50 and 15 are green. Candles outlined, order flow, stochastic, and momentum, and up you go. Now this is the most powerful entry we have. This is the C candle entry, and I'm going to show this to you over and over again on the on our trading charts. And what this shows you is this: you have a market move to the downside through a rising 50. Now remember, we only trend trade, and sometimes momentum is in different directions. The 50 can be up and the 15 can be down. That's why sometimes it takes a lot of patience to trade. And that's why we trade with specificity. We wait for the 15 and we wait for the 50 to come into alignment. And as the market moves down, the 50 rolls and eventually it turns red. Now, the A, the B, and the C are not put on the chart by myself. They are tagged on the chart by the software. And this is the software doing its analysis of market structure. Any two candles of the same color in the same direction create a trend. And the software is going to print an A. And the A, or the downtrend, is going to remain intact until somebody comes in and tries to buy the market and creates a blue candle or an up candle. Now you can see that now I just have liked to see the B candles print in magenta, because a B candle is a critical candle, because it tells you that a C candle may be coming, and a C is an engulfing candle to give you a trade. So the only audible signal we have on the chart is the formation of the Bs. When the B closes and prints, we get a beep. We get the audible alert. Now you can see that what these buyers in this B candle are trying to do is turn the market. We already know that the market's in a downtrend. That price action and market structure tell us that we're in a downtrend. Indicator analysis is inconclusive because the 50 is going up and the 15 is coming down. But market structure analysis, this is a definite downtrend. We've got one. You can count the doji, or I think this is a hanging man. Actually, this is a hammer, a form of a doji. But you have 1, 2, 3, 4 red candles in a row, and all of a sudden these people have decided, well, you know what? I'm going to take the market to the upside. Now, they're taking this counter trend trade, and more than likely these are the people calling the bottom. These are the people trying to trade against the trend, and more than likely they're going to get run over. And what we're doing is we're going to be waiting there to run them over. So what we do when we see the software flashing a C, we wait for the engulfing candle to occur. Now the range maker tells us where the C is going to close. We have our sell stop or sell stop limit order waiting one tick below the close of C. And when it closes and prints and the C stops flashing, it actually prints on the chart. This closes, you're in one tick below C, and down you go. Now by exploiting all the buyers in B, this market moves down with two forces. One is the addition of new buyers, and the other is the fact that we're stopping out all of the people in this failed counter trend move. That's what makes the C candle entry the most powerful one we have. Because and almost all of our trades you're going to see exploit the counter trend traders and acquire two forces, and that's the stopping out of the buyers here and the addition of new sellers. Now this is the actual entry here is a little bit obscured, and I can't tell if it's a momentum entry or not. But the same thing happens here. This is it's a C candle. It just barely engulfs. The same thing. Market comes down. Here the 50 and the 15 are confirmed. The market structure analysis, which tells us that we're definitely in a confirmed downtrend. Now, why would anyone at this point try to push the market up? Well, other people are trading other software systems that are trying to call the bottom, that are trying to call reversals, and trying to counter trend trade. And like I said, what they more than likely do is they're going to get run over and they're going to take a loss. So what we do is we sit back and wait for that C to mature. And this C also has order flow, stochastic, and momentum with it. It's hard to see, but it is outlined in light pink. It closes. You're in one tick below the close of the candle, and down you go. Now exploit this over and over again. There's another C candle. The market's down. People come in to form a B candle or push the market up in a confirmed downtrend. The C engulfs them. We're in one tick below the close, and down we go. Now we have other signals besides the C. They're slightly less powerful, but they still work really well. We get the move up, then we get the C candle. We get all these people turning the market. Then the confirmation back to the upside. This is a momentum signal. Now the traders in this counter trend candle are not engulfed, but because this is coming right off of our modified 15 with order flow, stochastic, and momentum, the candle surrounded in light blue, it confirms the fact, along with this plus, which is momentum aligning on multiple time frames, that the uptrend is intact. And in fact, we ride that uptrend up. Same thing happens again in this red candle here. You have traders trying to turn the market, trying to counter trend trade, trying to call a top, deciding that they want to take the market to the downside. Well, more than likely, they're going to take a loss because buyers are still here. The momentum signal here confirms that we're still in an uptrend, and you see the momentum signal flash intrabar. The candle is outlined in cyan, and that tells you that order flow, stochastic, and momentum are with you to the trade, and you take it to the upside. In both cases, the move to the upside continues on two forces. One, we know that the uptrend is still intact. We are the trend traders. We are the guys who are going in with the institutional money who are creating this trend. And two, so we know that additional buyers are going to come into the market. But we're also running over these people in this failed counter trend move. And as these traders get stopped out, they're going to push the market up even harder. Same thing here. And you can see the pattern occurs over and over and over again. And we have to wait for this pattern to occur. We have the 50 down, we have the 15 down, a confirmed downtrend, retracement right into the modified 15, thanks to these counter trend buyers, momentum signal, and back down we go. This is a power entry. The same thing. We have the 50 and the 15 are down. The downtrend is confirmed. Market goes down. Buyers come in, try to turn the market up. They get run over. More buyers come in. We don't have a signal here. We don't have a system-generated signal to tell us to go short. Buyers come in here. As the candle starts to move down, we have an arrow. That's a power entry. It confirms that the downtrend is still intact, and that's based on indicator analysis. And it confirms what we see in terms of market structure. 50 down, 15 down, indicator confirmation based on fractal analysis, and down we go. And we get the same signal here. We move up thanks to these traders trying to counter trend trade. We stick with the trend, the 50 and the 15 down. Market starts to push up, reaffirms its move to the downside. And you see it's very, very tight to the trend line. These are the trades that really work the best. And we're in one tick below the close of the candle, and down we go. There's a break of the 50 and the 15 with order flow stochastic momentum. And again, down we go. This is just a break. Now what I'm going to do is just show you one more thing that help us define the validity of the market. Now we did a significant amount of work looking at the oscillator. Now an oscillator is supposed to tell us when a market is overbought or oversold. Now what do you do when a market is overbought? As for an example, if the market is overbought, 50% of traders will then look for a divergence signal and look to short it. The other 50% of traders will then believe that if the market's overbought, that bulls are firmly in control of the market, and they're going to buy every upside broken pivot with the understanding that bulls are in control, and as high pivots are broken to the upside, they're going to continue to buy the market. So who's right? Does the oscillator tell you in an overbought market that the bulls are in control and continue, and your goal is to continue to buy upside pivots to the long side? Or is the oscillator there to confirm that the buyers we've run out of buyers, and via the use of a divergence signal, then now it's time to take the market to the downside? Well, when we looked at a year of market replay data, looking at the three-line indicator, determining if having the oscillator with us increases the predictive value of the trade, we found that it did not. And I think we're the first people to ever look at the utility of an oscillator. Now, it all sounds great, but nobody's going to trade against the MACD. Nobody's going to trade against momentum. Nobody's going to trade against order flow. But 50% of people trade against the oscillator direction. So we found that it doesn't really add anything to the predictive value of the trade. What we found is this. We found that the difference between the 50 and the 15 is what determines whether or not a market is overbought or oversold. And when the difference between the 50 and the 15 gets to be more than 18 ticks on an 8-range chart, then the market is oversold. So in the upper left-hand corner, we display this as the MA diff. And when we're taking a trade on an 8-range chart, we want the MA diff to be 18 or less. When it gets to be 19 and 20, we can still take a trade, but we understand that we're taking the trade with added risk. And that's what we want the platform to define for us. We want this platform in a very easy way to define risk, which is another way of saying it's going to define the positive predictive value of the trade. What is the probability that if I take this trade, I'm going to wind up getting to my target and getting out with a profit? Now, to further push the statistical analysis and try to make the predictive value of the trades even greater, what we did was we created a background. Now, this is a very, very unique indicator. It's the only one of its kind that I know of that's used on any trading chart. The price action and movement of the candles on the chart have absolutely no effect on the background. This background is all created by assimilating price action and market structure from higher time frames only. So what this is doing is telling you that for the period here where it's pink, that price action and market structure are predicting a move to the downside in the case of the 8 range on the 13 and 21 range. And when it's green, the price action and market structure on the higher time frames are predicting a move to the upside. So it really, really adds a significant component to your trading when you see that you're trading with background bias, because background bias is telling you, and it also tells you on a short trade that on those higher time frames, all support to the downside is broken. And when it's green, it tells you to the upside that all resistance to the upside is broken. So it's really giving you a lot of information that you would have to spend a lot of time with looking at 2 other higher time frame charts. Now, it's kind of a smart indicator because if you use the 8 range, it automatically assimilates data from the 13 and 21. If you use a 3 range, it automatically assimilates data from the 5 and the 8. Whatever your trading chart is, it's going to know it, and it's going to use 2 higher time frames based on its logic to create this background bias. So you can trade any time frame, any type of candle, and it will know it, and it's going to create the 2 higher time frames that we've programmed it to trade to create the background bias. Now, what I would like to do now is show you the trading platform itself. So give me 1 second while I reshoot the screen. Okay, now here's the actual charts that we use every day in the live trading room to trade. Now, let's take a look at crude oil. Now, let me just refresh the chart, because I don't think it's displaying the background bias. Here it is. We got it. It's back. Now, let's take a look at this trade. Now, these are all trades that we took live. And let's start in the morning. This is this morning. And I see some people in the room this afternoon listening to the lecture who were in the trading room today. And today was... this month, we've only had 2 days where we lost money, and today was one of the days that we did. It was the 3rd trading day of this month where we did lose some money. And every day, I post a YouTube video of the live trades that we took in the room, and I posted the trading from today. There is nobody else that does that has the kind of transparency that we do in trading, because our entries are pretty obvious. Now, I'm trading 6 markets at a time, and sometimes I do miss entries. But I want you to see how really what I talked about in the lecture is exactly what we're looking for. Now, here's the move down, and we're looking for a retracement into a confirmed trend. And here it is. Right here. The candle's outlined in yellow. I knew it was going to be outlined in yellow before the close of the candle. The 50's down, the 15's down. The candle has a 2/3 candle close below, and I entered the trade 1 tick below the close of the candle, and the trade went 15 ticks, and that was the first winner on crude. And then the market just kind of rambled along. Now remember, this fell through a yellow modified 15. And for us, that defines chop. Remember, we need the 50 and the 15 to be the same color to come into alignment. Now, background bias tells us that it's very likely that the market's going to fall and not rise based on market structure and price action on the higher time frames. So we're below the 50. Background bias is the darkest red, which means that's the strongest down bias we have. And we're looking for a short entry, and we just don't have any here. Modified 15 is yellow. And what we're looking for is what we get right here. There's the break, the retracement, and we're in one tick below the close of the candle. And the trade goes all the way to here. It goes 17 ticks. So we get 15 and 17. Just being patient and waiting for the market to set up. Now, if you were in the trade and got stopped out, could you have taken, there's that B candle that we look for. These are all the buyers looking to turn the market early. They are buying in a confirmed downtrend. 15's down, 50's down. Now, why the heck would they be buying the market here? Because whatever software program they're trading is telling them, well, you know what? The market's going to turn here. Here's the bottom. And they're wrong. They get run over by this C candle, and you could have taken another trade to the downside here or added on. We don't add on, but there's nothing wrong with it. You're in one tick below the close, and this trade would have gone another 9 ticks. Now, your third retracement in the trend, which is here, is kind of, remember we want that MA diff to be 18 or less. Well, here, the MA diff is 19. So here is where the market gets oversold. Now, if you wanted to be really brave, you could do it again. You get the break, you get the retracement right back to the 15. You have order flow, stochastic momentum with you on the trade, and you could take this trade down again for a third winner. Now, I think it's a little bit foolhardy to do it a fourth time. There's your fourth retracement in the same trend, but that would have given you 4 winners in a row. 1, 2, 3, and 4. And they're all handed to you by people trying to counter trend trade. Now, after you get your first 2, and the MA diff is greater than 18, we are not going to, in a live market on the right edge of the chart, trade a third and a fourth retracement in an overbought market. I'm just doing this to show you the power of trend trading, waiting for the retracement back to resistance when you're trading to the downside, and then the confirmation that the downtrend is still intact. You see this X? That's the momentum signal. That confirms the downtrend. Here, you don't need a system-generated move to the down signal. You've got all you need here. The 15, the 15, the 50, the retracement right back to resistance to the upside, and the move to the downside. Now, ultimately, here's where you're going to get stopped out. I mean, if you try to be crazy enough to take a fifth retracement, this one's going to come right around. And you don't know that's not going to happen here. But you've got 2 tremendous trades here. Now, this one took us 17, so we didn't have an opportunity to take the second one. Now, let's continue to watch. I'm going to give you my logic. Now, here, I didn't take this trade. There's no bias, and the 50 is red, and the 15 is green. I'm very patient. I want the 50 and the 15 to be green. Now, this was a trade. These were trades that I missed, and I always go and critique these. But there's your move to the upside. Come back. There's your entry right there, and up you go. And you had 2 opportunities to take it. If you missed it the first time, you could have taken it right here. There's the retracement and the move to the upside. And I just must have been looking at another market, because there was another retracement right here. And this huge move to the up, and there were other people in the room that got this one. And I remember people saying in the room, that's a huge move. And crude went all the way up 28 ticks. Now, it doesn't come with bias. And I like to trade with background bias. But you have the components that you need. The 15 up, the 50 up, the 15 up. The trade is a retracement right into support. You have the momentum signal. Order flows to cask and momentum is there. The candle's outlined in blue. Up you go. The issue here is to try to find a loser. And I'm telling you, you're going to be very hard pressed to find the loser. Now, these are not trades you would take, but there's another retracement. There's another signal. And there's another big move to the upside. Now, we're not going to take these trades. This is way overbought. I don't like to take a trade where there's only 2 ticks of candle body. And you get a feel for the system because the actual entries are all the same. The retracements into a confirmed trend. Now, as crude moves along, now here I took a loser. Remember I told you we would look for a loser? Well, here's a loser, and I'll show it to you. I'm not going to hide them. Let me take all this down. We had a move to the upside. A beautiful retracement. Background bias is green. Order flow, stochastic, and momentum. Now, the only reason that this was a -7 was because we have our trailing stop set too tight. This trade only came back 9 ticks, and our trailing stop is set at 7, and we've adjusted that today because really, this was really a trade that was a winner. I should have re-entered here, and I didn't, but if I had, I would have had a winner. And the only thing that gave us that loser this afternoon in the trading room, or this morning in the trading room, was the fact that our ATM strategy is too tight. That would have been 9 ticks. All we need to do is to make the trade profitable is to get to 5. And then we had this other entry right here for another move to the upside. And this is the problem I have in watching 6 markets. This is another gorgeous entry all the way up, 24 ticks. Now, we don't trade into unbroken pivots, but so you need 5 ticks from the entry to the pivot. We have plenty of space here to get to our first target. So we had 3 potential entries, here, here, and here. This trade and this trade are really either get in here or here for a win, or you get in here for a win. Okay, now I took this trade. This is a very risky trade. It was the last trade I took of the day. The retracement and the move down. And here, the 50 was yellow. And that's intermediate. If you really think that the trade is perfect, you can take the trade, and it drops 6. And 5 ticks was our target. Let me show you on the ES. Let me know what I'm going to show you the Russell. Now again here, I just have to refresh it because that's going to when you have a fractal indicator, sometimes the NinjaTrader it needs to be refreshed when you first open the platform. Okay, here's 9:30. Now here's a great trade. There's a move to the downside. There's your retracement. But the 15 is not red. Remember, we need the 15 and the 50 red. Couldn't take this move to the downside. That's specificity. Sometimes specificity will cost you a great trade. Here we had the retracement, the continuation trade to the downside. I didn't take it. It's the multi-candle retracement and the market was oversold. And this was a missed trade. I mean, unfortunately, I'm showing you a lot of my own missed trades. But there's the retracement. The 50 and the 15 are down. And that's a perfect short trade right here. You're in 1 tick below, and down you go for 19 ticks. And the more I analyze this, the sadder I'm getting because I really did miss a lot of trades. Here's the same thing again. The move to the downside, the retracement, and down for 18 ticks. Now here, we don't take the short trade because it's right into a pivot. And we respect unbroken pivots. And you can see that the pivot turned the market. Now this was a terrific trade, but we couldn't take it because the modified 15 was yellow. And that stops us from taking some trades. But our attitude is we don't care because we get too many great trades. And there's another one of them. The move down, the retracement into resistance to the upside. The downtrend is confirmed. The 50 and the 15 are down. Sure, I'll do that, DLA, no problem. A pivot is broken when 2/3 of the candle body closes below it. And you see that this is the candle that broke this pivot. And once the pivot is broken, it stops tracing. So once 2/3 of the candle body here close below this pivot here, the pivot stopped. So on this candle, you can see there's no pivot. The pivot's been broken. Support to the downside is broken, and now we can trade. This is the danger. The software does it, and if you look, if I squeeze, I'll show you. If you squeeze the market, now listen, you can change the sensitivity of a pivot. I believe that we have it so that very tiny pivots are not factored in. But if you do this, you squeeze the market, and let me take these out. You're going to see that the pivots, now these are huge pivots. Let me try to squeeze it some more. I'm trying to find the beginning. Okay, you can see that this pivot was created from this swing low here. It started tracing out a pivot. So what the market needed to do here on this pivot was break it to the downside in order to move lower. Now, you'll see what happened when it approached that low again. The market got turned around. Now, what the pivot is telling you is this is where the market changed direction in a significant way previously. So they're telling you that if you're a seller sitting right here at this area are lots of buyers. The last time that sellers tried to push through this area, buyers came and turned the market. So it's kind of a pivot's kind of a warning. It's telling you if you're selling, careful. There are a lot of buyers were sitting here the last time. Well, there's a potential that they're sitting there again. Don't trade into it. We didn't trade into it here. The market made an attempt to push through. It shot a wick through, and buyers were there, and they turned the market up. But usually, every time that a pivot is hit, it's weakened. You just don't know when it's going to break. This is a third hit of this pivot, and this candle broke it. Sellers were strong enough to push through. But then we had another area where the market turned previously. And you can see that the sellers were not powerful enough to put a candle body through. All they could do was shoot a wick through to the downside. And note the candle body couldn't make it if you tried to. Now, we didn't have a setup, but if you tried to trade through into this pivot, you would have lost the trade. So that's why we don't trade into pivots. But candlestick dogma tells us that if 2/3 of the candle body closes below the pivot is considered structurally broken. And that goes back a couple of thousand years to candlestick rules and regulations, and Steve Nissen's books, they're all in that. And there's another trade, a move to the downside, a retracement to the upside, and down for 10. Now, I missed a lot of them, which really, Now this is a trade I didn't take because it was into an unbroken pivot, but the pivot broke. There's another trade. Now this market was slightly oversold. The MA diff was 23, and we want the distance between the 15 and the 50 to be 18 or less. Now it doesn't mean you can't take this trade. It just means that if you do take it, it just has enhanced risk. And I don't like to take any risk. I didn't take the trade and it went 13. And then I remember this big drop, the Russell, we couldn't get it. There was no retracement, no way to get in safely, and we just don't jump into the middle of a trade with the thought in our heads, well, if the trade went this far, it's going to continue to the downside. And then I'm just going to take it to the end of the trading day here. Now here is, whoops, that's my, I just changed my trading statement. With a move to the upside, a move back. Now the C candles that are really tight to the pivots that are the ones that are most likely to break it. And this is a tiny pivot. See, that's only composed of a few candles. So this is a tiny pivot. It's a weak pivot. If you would have taken the trade one tick above the close, you would have been, the room is closed at this point. This is a great move to the upside. And this is a 41 tick trade. So I think you see how the trading works. It's the same thing on every single market. It doesn't matter what you trade, stocks, we trade the Russell, we trade crude, we trade the ES, we trade gold. It's the same thing. We're looking for a retracement in an intact trend. We're looking for the MA diff to be small. We want to trade right off of trend lines. We want to trade with order flow and momentum. These C candles are beautiful. In general, these tiny pivots don't matter, but these really, like this pivot, is a big, long pivot. I would not trade into that. It takes a little bit of screen time. Remember, people are going to tell you that you can take these dummy blue signals going long and these dummy red dots to go short, and the system is going to get you without thinking to be into profitability. That is not the case. You need to spend screen time on a system, and you need to work on the system. And anyone who tells you otherwise is simply misleading you. It takes time. But this system defines everything for you that you need to take only the trades that are very, very likely to be profitable. Now, sometimes you're going to have choppy days. I had a choppy day today, and I recalibrated it. We lost $80 today, and we took a lot of trades today. And for us, that's a terrible day. We're up well over $4,000 for the month, and we should close it on $5,000 for the month. And we're looking to make $1,000 a week after commissions, and try to create a net equity of $50,000 a year on trading 4 contracts. That's our goal. And to do that, you have to be incredibly consistent and avoid the big losing days, and just stay very, very conservative. And conservative equals patience. Sometimes we sit in the room for an hour without a trade. It's never chasing the market, letting the market come to you, give you the signal that you want. Now, are there any last questions? Because I don't want to keep you guys more than an hour. I know it's late, and I'm going to show you some how to get into the room. Let me just put the slides up one last quick time. Just hold on 1 second here. Let me shoot the slides. Okay, now we'll put a link in there. That's to come into the room for a free trial. What was the other, Leah? Now, we believe that 10% of trading is discretion. 10% of trading is discretionary. There is no way you're going to get away without requiring screen time and work. At Rightline, we provide you with extensive videos, group and personal mentorship. We support our software. We never ask you to pay for boot camps. We never ask you to pay for seminars or lectures. All our new indicator packages are free. We give you free upgrades for life. I really don't like the fact that people will invent a 2.0 version of their software and then charge you for the upgrade. I mean, what did you do? I mean, they shouldn't have sold it until the 2.0 version was available. I mean, if we find something new, we give it out to you. And once you become a member of our family, you get all the upgrades, all the add-ons, and everything. And we never charge you for additional money. Now, we do ask you to sign up for a free trial to our live trading room. Can you put the link to sign up link in, Leo? This is the link to sign up for our live trading room. We're at www.rightlinetrading.com. There's a link there to our daily net equity in the trading room. Our daily net equity, we have an auto trader that trades the same system. And there's a link there to sign up for our free trial. You can email us directly at info@rightlinetrading.com, or you can call us at 1-855-765-6681. We are here 24. I mean, we don't live here, but we sort of do. I mean, this is like our home away from home. And I just wanted to offer you a webinar special offer. Now, what we do in the room, and I'll just take 2 more minutes of your time to describe this, is we have what's called as direct entry software. And the direct entry software allows me to take the trades for you. And I actually enter them into your NinjaTrader platform for you and manage the trade for you. I call out the trade because some of the people in the room trade manually. A lot of people in the room are under the direct entry. I enter the trade, I manage the stop, and I manage the targets. Now, normally we don't sell it, but as part of this package, we would give you all of the software that you saw, and the video tutorials, and the direct entry software, and 2 hours of personal mentorship with me, and we would give you 2 months in the live trading room as part of that package. And that special will be $29.99. And if you have trouble buying that in one lump, we can give. If you call me, we can work out a payment schedule for you. But that's our webinar special, and we'll leave that up for the rest of the week on the website. So that's it. So are there any last questions? Okay, well, listen, we welcome everybody to come into the room. This is going to be on video, and you can watch it. And we hope we'll see you in the room for a free trial. Or if you'd like to buy the webinar special, we welcome you to our family. So thank you so much for giving me your time. And I really wish everyone